Welcome back to another episode of Bias and Money, where we break down real financial events and the psychological mistakes behind them. In 2008, one of the most powerful and respected institutions on Wall Street collapsed in a single weekend. Not because of bad luck, not because of one unpredictable event, but because of a decision that felt rational at the time. Lehman Brothers was once the fourth largest investment bank in the United States. For decades, it symbolized financial intelligence, prestige, and control. Inside its offices were some of the brightest minds in finance, supported by sophisticated models, advanced risk systems, and decades of market experience. And yet, none of that was enough. Between 2003 and 2007, Lehman aggressively expanded its exposure to mortgage-backed assets. Its holdings in real estate-related securities grew from roughly $30 billion to over $100 billion in just a few years. At the time, this decision appeared reasonable. Interest rates were low, housing prices had been rising consistently, defaults were minimal. The prevailing belief across Wall Street was simple: the housing market was stable and the risks were manageable. But hidden beneath those assumptions was a dangerous illusion. Lehman wasn't just betting on housing, it was betting on its ability to control risk. By mid-2008, the firm was operating with a leverage ratio exceeding 30 to 1. That meant a small decline in asset values could wipe out massive portions of its capital. And when the market turned, that leverage stopped being a tool for growth. It became a weapon. In September 2008, Lehman Brothers reported a quarterly loss of nearly $4 billion. Confidence evaporated almost instantly. Investors pulled back. Counterparties refused to lend. Within days, Lehman filed for bankruptcy with over $600 billion in liabilities, the largest bankruptcy in U.S. history. But the most important part of this story isn't the numbers, it's the psychology behind them. Lehman's leadership suffered from a classic cognitive bias: overconfidence. They believed their models were superior. They believed their judgment was more accurate than the market signals. They believed that past success meant future control. Richard Fuld, Lehman's CEO at the time, publicly stated that the firm was fundamentally strong, even as internal risk officers raised concerns. Warning signs were dismissed. Negative data was rationalized away. Only information that confirmed their existing beliefs was taken seriously. This is known as confirmation bias, and it's one of the most expensive mistakes humans make. Psychologist and Nobel laureate Daniel Kahneman once said, "Overconfidence is the bias I would eliminate if I had a magic wand." Lehman didn't fail because its leaders were unintelligent. It failed because intelligence without humility creates blind spots. And this is where the story becomes personal. The same psychological trap that destroyed Lehman shows up every day in the lives of traders, entrepreneurs, and investors. Doubling down on a strategy because it worked once. Ignoring risk because confidence feels productive. Believing that effort, intelligence, or ambition alone can override uncertainty. Ray Dalio, founder of Bridgewater Associates, summarized this lesson clearly when he said, "No matter how sure you are about a bet, you can still be wrong." Lehman's collapse didn't just destroy a company, it triggered a global financial crisis. Millions lost jobs, savings disappeared, trust in the financial system collapsed, and all of it began with a simple human error: the belief that control had replaced risk. The real danger in money isn't volatility, it's believing you're immune to it. Thank you for watching. If this story resonated with you, you'll find additional resources and learning material linked in the description. They go deeper into how these psychological biases shape real financial decisions and how to avoid repeating the same mistakes. I'll see you in the next episode.